Hello and welcome to United Asset Strategy's second quarter investment call. My name is Thomas Healy. I'm the Chief Portfolio Strategist here at United. And with me today is Jiorden Sanchez, one of our senior portfolio managers. We're using a little different technology today so that we can incorporate slides, which we think will enhance the experience, and you'll get a better sense of what we're seeing as you're able to see it as well. Before we get into the second quarter update, I just wanted to give an update on the coming integration of TD and Schwab. As you know, for clients of ours that are at TD Ameritrade, the third quarter will see the integration of the platform with Schwab. As a result, all TD Ameritrade institutional accounts, i.e. those that United is managing, will be transitioning to the Schwab platform in September. The one thing that our team wanted to reiterate was your relationship with the United Asset Strategies remains unchanged, as we have long-standing relationships with both TD and Schwab. So we just wanted to make sure that was clear, and you'll be hearing more from United on that. But now let's just jump into the second quarter. As we noted in our letter that is going out, the second quarter theme would be the trend is our friend. And that is an old adage on Wall Street, and we've seen that. We saw a recovery from last year's decline starting in the fourth quarter, continue into the first quarter, and many of the same trends that we saw in the first quarter have continued here into the second quarter. For example, the S&P 500 for the second quarter was up a little over 8% and is up almost 16% for the year. In addition, the drivers remain the same, i.e. growth stocks. You can see the Russell 1000 Growth Index up 12.5% in the second quarter and up almost close to 30% now year to date. While value stocks are up about 5% year to date, they've definitely lagged growth stocks. But there's a lot that we can get under the hood with. And to do that, I'm going to turn it over to Jiorden to get more detailed.
So thanks, Tom. So to your point, the second quarter was a very strong quarter in the equity markets. And we're going to use this slide right here to put 2Q in a bit more perspective. As you can see, this slide, recaps the bear and bull markets over the last 1.5 years. That's the black line. And as shown, the markets bottomed in the fall of last year, down about 25% from peak levels. But given that strong rebound we've had since, the market's nearly recaptured all of those losses and now is just down 7% from those peak levels. Below that exhibit, really quickly, we point to some of the key drivers of market price changes. This includes earnings forecast, that's the gray line, valuation multiples, that's the blue line, and some inputs into how valuation multiples are determined, namely, the prevailing interest rate, which is the green line, or the equity risk premium, which is the red line. The upshot to all this is valuation has been the primary driver in the good and bad times over the last 1.5 years. So for example, you could see during the bear market of 2022, the market's decline came despite strong earnings, and it was largely a function of a very steep decline in multiples as interest rates rose, which typically makes bonds a bit more competitive versus stocks. In the subsequent bull market rally, once again, valuation multiples were the primary driver. And this time it was during a time where interest rates were relatively stable. You can see that there on the green line. But earnings forecasts actually started to bottom and start to grow again. And so given that improved outlook, at least, we've seen investors willing to assign a lower equity risk premium to stocks. And that was the primary driver of stronger market moves. So overall, people often say bull markets climb a wall of worry. And I would argue that this time is no different. Recall entering the new year, the investment community was very concerned with a looming recession. And so it's particularly interesting to see this level of strength in the market, especially as it relates to kind of the key drivers and the reasons why it's higher. So shifting over to the next slide, we would dive into a bit more deep detail on the rally we've seen since the fall of last year. So this really breaks the rally up into two phases, phase one and phase two. But by and large, you see the overall equity market, which is the black line again, and its trajectory over time. And we're charting that up against the equal weighted S&P 500. The key difference here is it's equal weighted, which means it's a better sign of the typical or average stock in terms of how it's performing. The key takeaway here is we began to see a divergence in the second quarter, where we started to see some significant outperformance for the overall market versus the typical stock. And once again, on the bottom part of the exhibit, you see that it was largely due to more multiple expansion for the former versus the latter. Now, driving down a bit further, I would just go to the next slide, titled Magnificent Seven. This one focuses specifically on 2Q to see what was the driving force between that divergence between the overall market and the typical stock. So on the left, you see 2Q total returns. And you can see that the strength was primarily driven by large cap stocks, growth stocks, as Tom alluded to in his opening remarks, and sensitive sectors. But on the right, we try to strip out kind of some of the more meaningful drivers of the market performance in the second quarter. So what we've alluded to here is the Magnificent Seven. These are the largest seven tech stocks in the S&P 500. The constituents of that group is listed on the bottom of the slide. But the upshot here is these stocks account for about 25% of the market, and we're up about 23% in the second quarter alone. That strong performance, given their size, contributed to about 6 percentage points of the market's total 9 percentage points of performance. Conversely, the remaining 490 or so stocks were a bit more muted. You can see that they were really just only contributed to about 3 percentage points of total return. So to sum all of this up, the market had a very swift rebound from last year's low. This came despite what many people were concerned about earlier on the year, which is the looming recession, given the significant rate increase we saw last year. But the key questions moving forward is, does the rest of the 490 stocks trade higher, catch up to the Magnificent Seven? Or do we see the Magnificent Seven trade down, lower back towards the more broader market? I think the answer there is really going to rely on earnings. And as it relates to earnings, a key input is the economy. So at this point, I'll just really quickly turn it over to Tom to provide a bit more commentary on the macro backdrop.
Thanks, Jiorden. So the question that we try to answer in the letter and that most economists are struggling with is a recession inevitable? And let's start with the case for a recession. The first thing that we would note is Fed policy has gotten much more restrictive over the last year and a half. And that's obviously most notable in the increases in the Fed fund rates that we've seen over the last year and change. But the other thing that doesn't get as much press is that the Fed balance sheet is now starting to move down. Coming out of the pandemic, the Federal Reserve was ramping up its balance sheet at the same time that the federal government was increasing fiscal spending in order to really stave off an economic collapse. Now they're starting to pull back. Both the Federal Reserve and also the fiscal policy are becoming more restrictive, and that is taking liquidity away from the economy. So that's a major headwind to be noted in. The second thing we'd note on the next page is that this is the index of leading economic indicators, the LEI. Now, this it's 10 different economic data points that each point to early turning points in the economy. So it tends to be predictive of a slowdown and or recession in the economy. So you can see here from the chart, those areas where it's gray is where we've had recessions, and it coincides with the red bar that the Conference Board, who puts this indicator together, has suggested is a recessionary environment. We saw that the last 3 times. As you can see now, given the 15-month decline in the LEI, we're now in that recessionary phase, according to the Conference Board. In fact, they're actually calling for a recession in 2023 based on elevated inflation. We know it's come down, but it remains higher than normal. Tighter monetary policy, which we discussed on the last slide, and reduced government spending. So there is a strong case to be made that we are or will be going into recession. But what's the counter argument to that? As we look on the next slide, it starts with the consumer stress indicator. And that is basically, Strategas puts together this composite of food plus mortgage rates plus gasoline prices. And with food coming down, particularly things like eggs, and gasoline prices coming down versus last year, even though mortgage rates have moved to pretty high levels, it's come off overall pretty significantly. So there's a meaningful amount of pressure that's been taken off the consumer. At the same time, if you look at the next slide, the consumer's income or wages have gone up. And this is a mixed blessing. This is the real hourly earnings growth. Now it's moved into positive territory. The mixed blessing is that while this is good for the consumer, meaning there's more money in the consumer's pocket to do things like spend and support the economy, the Federal Reserve is also looking at this as a concern in terms of wage inflation. So, but the bottom line here is the consumer is feeling better as a result of less pressure from costs, and then the addition of higher earnings growth. And then so the next page sums it up. This is the University of Michigan Consumer Sentiment Index, and it's an index that measures both how are consumers feeling from a wage standpoint and also from a cost standpoint. So looking at the previous two slides, you can see that now the result of that is a real increase in the Consumer Sentiment Index in the most recent reading. This is the highest level we've seen since September of 2021. So the bottom line is, even though there are definitely indicators, particularly on the manufacturing side, that are pointing to recession, when you look at more of the service side of the economy, the consumer, it's painting a very different picture. The labor market remains supportive, and with that, there's typically not a significant recession when the labor market is solid and the consumer is feeling more confident. So that's the duality of what we're watching right now. And I'll turn it back to Jiorden to discuss what this also means now for earnings and equities.
Thanks, Tom. So, in discussing our outlook for the equity markets, I would like to start with valuations. So moving to the next slide, this slide walks through the multiple expansion we've seen since the trough of the market, with a particular focus on the valuations we're seeing today, both including and excluding the Magnificent Seven we previously outlined. So at the top of this exhibit, what we see here is that the S&P 500 is clearly up significantly from its lows, and is primarily driven by a 4-turn increase in the valuation multiple. We've seen valuation multiple go from 15 times in the fall to about 19 times now. Now, with this S&P historically trading at about 17 times, the market has essentially gone from 2 turns cheap to 2 turns expensive. Now, that said, an outside portion of this upside has been driven by the Magnificent Seven, and I think this exhibit clearly indicates that. You see that this Magnificent Seven has increased from approximately about 26 times to about 34 times in terms of valuation. From a historical context, not only are these multiples expensive versus the broader market, but they're also pretty expensive in the context of the rate environment we're in. Now, this begins to kind of make sense if you start thinking about the quality and growth attributes that these stocks have. These are typically things that investors look for during times of uncertainty, but only time will tell if this level of multiples are justified, and I think we really have to see how earnings play out in the interim. Now, at the bottom of the slide, what you end up seeing is how valuations are looking for the remaining 490 stocks in the S&P 500. And while these stocks have also seen their multiples expand, they're still trading at pretty attractive valuations. So for example, you see these stocks currently trading at about 15 times relative to their long-term average of probably about more like 17 times. So they're still relatively cheap despite some of the strength we've seen in the market. Now, we view the trajectory of earnings from here as the key focus for investors, and that takes me to the next slide. So this slide, once again looks at the leading economic indicators, or LEI, a topic that Tom Healy discussed a few slides ago. And what it really highlights is the strong relationship between earnings expectations for the S&P 500 and the LEI. And more specifically, the strong relationships we see with cyclical sectors within the S&P 500. And the upshot here is that while valuation for the broader market isn't necessarily demanding, there may still be some earnings risk here should we enter a recession and the historical relationship between the EPS and the LEI hold. So in short, only time will tell. Can the Magnificent Seven report earnings that justify their premium valuation? And can the other 490 stocks, are they cheap enough now to withstand potential earnings cuts should we enter a recession? Those are all things we'll have to answer over time. But what I will say is that the early read is positive. We're currently in the middle of 2Q earnings season. A little over half of the stocks have reported, and so far about 80% are beating expectations. This compares to about mid 70% historically. And when they beat, they're beating by about 5 or 6% on earnings. And once again, that compares to about mid 4% historically. So earnings have been strong so far. And, what we've also seen, earnings expectations and forecasts continue to trend higher so far this quarter. They're up about another 2%. So when you take all that into account, the recent data points are still pretty positive. Now, I would just close with how we're positioned for our clients in our equity portfolios. No matter how strong or weak the markets, there's always some risk to manage around. And during this presentation, we highlighted how there are pockets of the market that are starting to screen expensive, and there are pockets of the market where we're seeing some earnings risk. So along those lines, we always try to strike a delicate balance by allowing clients to maintain equity exposure and participate on the upside while also managing around some of the risk we're seeing. So from a top-down perspective, depending on the particular strategy, we'll have a mix of cash and or hedges in the form of gold or inverse equity ETFs that should limit overall portfolio volatility. And from a bottoms-up stock selection perspective, once again, depending on the strategy, you'll see that in certain strategies, we're making sure to be underweight, cyclical sectors to the extent we enter a recession. We're also choosing to overweight higher quality names with more resilient earnings profile or secular growth characteristics. And while we like the long-term prospects for the Magnificent Seven broadly, and we do own most of them in our strategies, we have chosen to take a slightly smaller position than you would have seen in the overall market, given our preference to remain a bit more diversified, given some of the lofty valuations we see. So overall, your money is in good hands. And at that, I'll close and turn it over to Tom Healy for any closing remarks.
Thank you, Jiorden. And hopefully you appreciate the depth of the analysis today and understanding of the different things that we're looking at in terms of economic policy, fiscal policy, government policy, earnings, et cetera. If you have any questions about any of what you heard today, or including the TD Schwab integration, please don't hesitate to reach out to your advisor or your dedicated client experience team member, and they'll be glad to give you more details. So thank you, and we'll see you after the summer.